Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the fifth episode of our airline series. Behind me is JetBlue. Let's dive right into JetBlue. So what you'll see here is a growth story of JetBlue beginning at $4.5 billion in 2011 and growing to $8 billion over the decade. That is a 7% annual growth rate, which is a strong growth rate for the airline industry. And it's nice to see a top-line revenue growth from one of the providers. Getting EBITDA, we're taking operating income plus depreciation to get EBITDA. And here, EBITDA is also growing nicely. In fact, it's outpacing revenue, which is another hallmark that we like to see. We've grown EBITDA, they've grown EBITDA from $570 million to $1.3 billion over the decade. That's roughly a 19% growth rate. That growth rate's larger than revenue. It means margins are growing. So we got top line revenue growth, earnings growth, and earnings are growing faster than top line. All right, let's look for enterprise value and see how the stock has historically been valued. We're going to pick up with our debt. That is current portion of long-term, any lease obligations they have, and any pension or retirement obligations. Those are all debts that have to be paid and will come due. We add those up. We add the market cap. Market cap is shares outstanding times price. We add that to get enterprise value. Enterprise is the entire business. If you're buying an airline, you need to think of yourself like a tycoon, that you want to be in the airline business and you want to be there for a long time. So we look at the enterprise value, not the stock price, because the stock price moves all the time, every day. Enterprise value here ended $8.8 billion. How has the market valued JetBlue over time? Well, it's ranged from a low of 5.5 to a high of 10.8 multiples of EBITDA. Currently average, at least last fiscal year, of 7.6 times, which is very close, actually a little under the 8 that we've been seeing for the industry thus far. On a leverage basis, so JetBlue started the decade with a little higher leverage than we would like. 6, 5, and 4 times EBITDA was too much early in the decade, and they've wisely brought that down. They brought it down to a low of 1.2, and they've kind of grown it recently to 2.4 times EBITDA. Higher than their low, but still below our 3 times maximum we like to see, and I think is a prudent spot for the airline. I'd rather it be a little lower, but it's nice to see that they're not too highly levered. Let's look at free cash flow, see if that lines up with our EBITDA. Here's cash flow from operations. It started the decade at $614 million, and it's grown to $1.44 billion over the decade. Excellent growth, and that growth is in line with the EBITDA growth that we have seen. CapEx, again, buying of airplanes, reinvesting itself to deliver that growth. And you'll notice this CapEx is pretty close to the cash flow from operations. So they're basically taking all the money they have and they're reinvesting it into the business to grow. And I'm guessing that's how you're seeing the top line revenue growth of 7% that we didn't see in other airlines, because this gap is a whole lot smaller. In addition to that, they have been able to pay down debt. You can see that here with this negative, there's their debt payments going down, which is great to see. That's also the lower leverage that we saw kind of mid-decade. Recently, they have been borrowing, and you saw that in recent debt statement that has gone up to 2.4 times EBITDA. That's this extra borrowing here. On a share count basis, they've grown their shares 6%. So basically, they're not buying back. They're not really issuing. That's kind of a low number, probably employee comp for hitting target. But they've been largely flat on the shares, giving you a pretty decent cash flow per share, at least recently. Looks like it was negative early in the decade because they were buying back debt. All in all, they currently have a yield of 1.4 with a negative growth rate. That growth rate to me strikes me as a little odd. Just massive swings up and down. I think that's because of the positive negative nature you're seeing in the yield. But we know that the Free cash flow is tight with the EBITDA, and they can afford the CapEx, so much so they're even buying down debt, which was nice to see. Let's forecast a price forward. So here I'm picking up the free cash flow to equity that they've averaged for the last 3 years, and I'm saying you're going to get zero credit for it in the next couple years for the struggle that they're going to go through. I'm growing it to $2.04 and I'm applying an average airline market industry yield to it for a $40 price target. If I do the same thing for EBITDA, all right, if we look at the growth rate of EBITDA, you start it next year at $1.15 billion. That's probably obviously not going to happen. They're hemorrhaging money right now. But if they survive, and over the decade, I'm giving them a very mild growth rate, that they'll be at $1.6 billion of EBITDA in 10 years. A market multiple, an average market multiple for the airline industry gives me a $13 billion enterprise value, or essentially a $28 stock price, assuming additional dilution to help save the business of roughly 10% of shares. If we add these together, both our free cash flow method and our market multiple method, we're going to come up with an average price between the two valuation metrics. And you can see that there at $34, averaging the two. It's currently trading at $7.95, which is a pretty big delta. If I plug that into an IRR calculation, so if we plug that sale price into our IRR metric, you're going to see you start the decade by buying the stock for $7.95. You get zero cash flow in the next couple years as they try to fix the business, struggle to stay alive, and over time they produce cash flow and eventually get back to their intrinsic value of $34. That return is quite healthy at 26% IRR over the decade. That is one of the highest we've seen thus far on the channel. And for that, that's essentially a 6 on 6 cash return, or six times your money. Say cash on cash. I can't talk today. It's 6 times your money if you bought it at $7.95 and you get out at the $34. Annualized, that's a 26% IRR. All right, so this is the end of the series. So we've done all 5 stocks. We have done, let's recap, we've done Delta, we've done Southwest, United, American, and now we just did JetBlue. Thank you very much for watching. The next video is going to be the consolidated summary where we talk about these businesses as a whole. My name is Cameron Stewart, CFA. Thank you very much for watching. Please subscribe and comment. Bye-bye.